Hey everyone, good morning and welcome to our DAT IQ weekly market update. We're here every week talking about the freight markets on Tuesday, generally at 10 a.m. Eastern, but much like the Ohio State Buckeyes, we're a bit of a disaster this morning. And we've had some technical difficulties, so please bear with us. I'm Ken Adamo, Chief of Analytics at DAT, joined as always by Ned Damon, who's our Principal Data Scientist, and Dean Croke, who's our Principal Industry Analyst. Welcome, guys.
Good morning.
Morning.
Did you catch any of the game last night?
No, I was driving all over Halifax.
Yeah. Nick Saban is a bad man. He is a bad man.
It was a blowout score, isn't it?
Yeah, it was. As someone who is an Ohio transplant, who doesn't really have a college team, I just root for the Big Ten in general, and it was it was disturbing. I thought they were going to have to blur some of it out to make it TV 14. To be honest with you. So we have a lot to talk about this week. I wanted to get a couple things out of the way from a housekeeping perspective. First, we released a top 10 lanes report, which we're going to talk a little bit about in the end of the show, but you can find that on our website. It talks about top 10 freight markets, not lanes, for each of our primary equipment types that we observed in 2020. Some really cool stuff there. I encourage you to check it out. Again, I'd like to encourage you to check out the Chris Caplis's Freight Find podcast. He has some really interesting guests lined up for the first quarter of this year. And if you'd like to follow or hear more about the broader supply chain and procurement space, I really think it's a worthwhile listen. So with that, I'm going to jump into our key trends for the week, and then we'll get rolling. So the first thing we're watching is the first full week in the books. We're kind of seeing how things return as the dust settles from Christmas. Dean's going to have some interesting charts to show that really bring timing, the importance of timing into perspective, just in how the holiday fell and how that impacts kind of the last and the first week, official week of the year in our charts. I think the most alarming, or at least the most interesting for sure, thing that you'll see in our show today is where rates are starting out 2021 compared to prior years. That we lose sight of it when it's at the tail end of one year because that's typically a super busy time, whereas a new year brings a reset in a lot of things in life. I think the way that it resets on the chart is very startling if you're watching freight rates. There's a lot of going on around imports shifting, a lot of that due to congestion and some other factors, which Dean will touch on. And then sort of all the things tangent to freight that we're watching, kind of like cloudy with a chance of revolution. But we have the healthcare crisis and economic stimulus, two major top stories that could shape freight over the next few months. So with that, I will turn it over to Dean to walk us through our market dynamics and rate trends.
Yeah, thanks, Ken. Interesting week. This was the first full shipping week of the freight year. It's typically a catch-up week. Capacity returns to the market, especially in the long-haul sector. A lot of short-haul drivers are still on furlough. But shippers begin to work through their backlog of freight from that week in between Christmas and New Year. So as a result, the load-to-truck ratio moved up last week to 6.67. No surprise there. Next week's load-to-truck ratio will be more indicative of how January is going to play out as we head into the second full week of the shipping year. In the refrigerated sector, very similar to dry van, the reefer market played catch-up also. The load-to-truck ratio shifted up to 12.49. More than very, very high compared to last year, as you can see from the chart, about 64% higher than 2020, but not quite as high as the load-to-truck ratio in 2018, but two very different years from a economic driver perspective. In flatbed, load-to-truck ratio moved up to about 50, but again, that was as a result of the catch-up week also. Volumes weren't as high in flatbed. Last week in the market condition index for dry van, the most notable market movement this week has been the dramatic fall of both Los Angeles and Ontario markets. They last week were number 23 and number 27. If you remember from previous broadcasts, they were our number 1 and 2 markets for many weeks during the import surge as shippers restocked their depleted inventories. That's been a dramatic drop. Rates were very high when those were number 1 and 2 markets, up to the $3.29 per mile mark. Now they're down in the mid $2.90 range. So a lot of congestion, as Ken mentioned. Shippers have been diverting containerized volume. The Gulf Coast has been one of the big beneficiaries in Houston. We had a look at the import volume from the Piers database yesterday. Houston container volumes are up 28% year over year. So by the time that volume clears the docks and heads through the transloading facilities and onto trucks, last week we saw a 31% increase week over week in outbound load post volumes. They're up more than a double year over year anyway. Still plenty of capacity in the market. Spot rates dropped 13 cents a mile to $2.10. This is going to be a market to watch. In particular, Houston's just added a third shipping alliance from Asia. So we're going to see a lot more big 14,000 TEU vessels start to enter, especially as they start to spend money dredging and widening and deepening the harbour. So a lot more volume is going to hit the Gulf Coast from around to New Orleans and, of course, over to Miami and up to Jacksonville. In the refrigerated market, we're seeing a lot of South American produce volumes hit ports like Philadelphia and Wilmington. In Philadelphia this week, volumes are up 22% week over week. Still plenty of capacity in the market. Rates dropped 8 cents to $2.57. A little bit further north in Elizabeth, New Jersey, that's the number one volume market for refrigerated last week. Rates dropped also 15 cents a mile to $2.19 on higher volumes. So still plenty of capacity on the East Coast markets. On the West Coast, outbound load post volumes in Twin Falls, Idaho increased 46%. Rates declined, still plenty of capacity in the market. Capacity was much tighter in Seattle, which is a bit of a surprise. Rates jumped 18 cents a mile to $2.02. Outbound volumes in Seattle last week were up 63% week over week. In the dry van sector, load post volumes in the majority of markets were higher compared to the prior week, but Memphis and Little Rock maintained their number 1 and 2 positions. Capacity was a little bit tighter in Little Rock. Rates went up, our 3-day rates went up 22 cents a mile out of Little Rock, $2.74. Lakeland again was the number 1 destination for loads out of Little Rock. In the flatbed sector, rates jumped 13 cents a mile on that lane to $2.68. But that's more a reflection of declining 3-day rates on the return journey, which is still down around $1.31 per mile. Jumping over to the dry van spot rates year over year view, as Ken said, we're starting the year at a very high level. Typically, at this time of the year, rates start to decrease as the year gets going. But the difference this year is we're starting from a much higher level than we've ever seen before for this time of the year. And as they were in the second half of 2020, spot rates are currently at record levels for this time of the year at $2.27 a mile, although they did drop a couple of cents over the course of the week, still up 29% and 65 cents a mile higher than the same week in 2020. Interestingly, if you follow the 2018 year, that was a year of very tight capacity, double-digit rate increases. We're still about 36 cents a mile higher than where we were in 2018, just as a way to put a stake in the ground to see where rates are going to go. In the refrigerated sector, much the same. Rates dropped 5 cents a mile to $2.50, 52 cents a mile higher than where they were in 2020. They were $1.98 this time last year. And in the flatbed sector, rates dropped slightly, only by $1 cent per mile to $2.20 per mile. They've been in that range since October, but compared to last year, rates are up about 37 cents a mile. So that's it for the market update this week. And if you'd like to find out more about what's happening in freight, go to dat.com/resources and download the extensive market update that we push out each Wednesday. So that's it on the rate side, Ned. Over to you for the forecast.
We're just getting Ned back from a power surge, so give him a second to get situated and back on screen. There he is.
Can folks hear me? Okay. Is
Sun returns.
Nothing like
You there, Ned?
Okay. All right. Everything should finally be back to normal. Let's do some forecast. Jiminy Christmas. This is not how you want a live broadcast to go. So let's look at some forecasts. Let's start off with our national dry van forecast. You can see we got some spicy this week. Blue is the market rates observed by DAT. Green is our RateCast, which is our flagship model. Red is a short-term model that is designed to try and focus on short-term trends much more heavily and discount seasonality more, or rather take seasonality less into account. And the blended forecasts in gold and gray are mixtures of these two forecasts in different amounts and different proportions. I remember last week, RateCast was saying that things were going to start to flatten out and head down, and remarkably enough, things are starting to flatten out and head down as part of the normal seasonal pattern. And RateCast is foreseeing a future kind of slow decline. Whether it's going to level out or whether it's going to continue to head downwards, I think is going to be an open question as we head into the early part of February. Moving forward to the reefers, we have a similar chart where blue is the market rates observed by DAT, green is the RateCast model, and then we have our short-term model in red and our blended forecast in gold and gray. And you can see here, again, RateCast is expecting there to be the sort of standard seasonal pattern of things heading downwards in a relatively smooth way. There's an open question about whether or not they're going to flatten out in the early part of February, whereas short term is expecting a little bit more of an immediate pickup. I don't really see that happening, but I have been surprised before. Finally, we're moving into the flatbed space. The flatbed model, again, has the market rates observed by DAT in blue and the various model spaghetti off to the right, RateCast in green, short-term in red, and the blended forecast in gray and gold. And you can see here that there's a lot more model agreement, that things are coasting downwards in kind of a slow, orderly pattern. RateCast sees things leveling off as we move into the later part of January and the early part of February, whereas the short-term model is expecting the trend to continue. And that's about it for the forecasts. Are there any questions, do you think, Ken, before we move on?
I'm going back to the dry van one.
Yeah.
It looks like we cut about half the distance between 2021 now and 18 by the end of the forecast horizon, which is
it's
first week of February. We need to fix those axes, right? We need to.
Yeah.
They've been fooling us all year with how the forecast has moved, but if we could tighten up those axes a little bit, I think you'd see more movement.
Mm-hmm.
Just axis, sorry, just the Y is what I'm talking about. I don't know. I mean, I think if you combine this with the chart we showed about the year-over-year dry van spot rates, that would be a great way to teach kind of a new hire in freight analytics about risk. Right? I think there's a lot more room to go down than there is to go up, especially in the dry van space over the next couple of weeks.
Yes. And I think that's going to be the really interesting question is, as you've noted before, typically in a freight cycle, things tend to move back to their equilibrium point. I remember a chart you had a couple of weeks ago on the show where there was essentially no vertical movement over the course of a whole 2-year freight cycle, vertical meaning like price movement. It kind of went back to where it started. And I think it's going to be an open question about whether that happens here. Again.
Yeah, I mean, if you only checked in on the freight markets every 18 months, you'd say things never change.
Mm-hmm.
Right? Even though it's just these dramatic swings in both directions. So I think that perfectly tees up our question of the week, Ned, if you want to do us the honor.
Certainly. Let me pull it up.
And while he's doing that, if you guys have any questions, I know we've had some technical difficulties with YouTube. If any of our YouTube listeners have followed us over to LinkedIn, feel free to drop a question in the chat or comment section. We have a team of folks that are going to get those over to us to hopefully give some insight.
So our Ask IQ question for this week is, what do we expect to happen over the next 6 weeks in the freight market?
I can start. I think looking at it from a rate perspective, sorry, I'm not looking at the camera because I'm pulling it up. Again, I think we've been pretty consistent in our thinking that the rates are much more likely to go down than up. And I think at this point, pretty much every path to rates continuing to rally in the first quarter has been exhausted, especially in the spot market, or if not exclusively on the spot market. So I think the real thing to watch is how far they pull back. Is it more of a correction downward before they level out and sort of suss out what 21 really has in store for freight rates, or if we equalize to 18 or even below, right, where we maybe started the year in 19. Because I think a lot of that has to do with, or at least it'll be telling of, kind of, is this the culmination of the up movement of the freight cycle, or does it still have some more steam left, and that doesn't happen until potentially later in the year? And what I mean by that is, till we start to inflect in that typical pattern where we'll begin a trough cycle over a 12 to 18 month period. But what are you guys seeing?
I mean, I think the really open question. I think there is. You're right about Q1. The upward path being not very strong, but I think there's definitely an outside chance that if vaccinations happen and COVID lockdowns stop, that there's a lot of pent up demand for people to be going out and doing things. And I think that could, I mean, depending on what the cash flow situation is for folks, it could cause another little bit of dislocation and rising rates as things shift back to the way they were before, because a lot of the networks have adjusted. And so an adjustment even back to normal is going to likely cause some rising rates as things are out of position and people are willing to pay a premium.
Well, I think we've talked about this in multiple shows leading up to the end of the year and even in the new year. I think there's three main points, like a three-legged stool, if you will, that's going to dominate freight direction in 21. It's going to be consumer spending on the demand side. It's going to be higher contract rates shifting demand back to the contract market from the spot market. And it's going to be an increase in supply driven largely by the tremendous rally we've seen, this pent-up rally in Class 8 truck orders. So two of those three are on the demand side, right? The consumer spending and the contract piece, and one on the supply side. And I guess to the extent that consumer spending could outrun those other two deflationary pressures on the spot market, that's probably the outside chance that you're speaking to.
Yeah. Yeah, I wouldn't put a lot of money on it, but
yeah. What are you thinking, Dean?
Yeah, I'd agree. I think the important point is that a lot of those higher contract rates start to divert some of that spot market volume back to the contract market. But I think it's to the extent we control the spread of the virus. I think the economy and the vaccinations and the virus numbers are all interlinked. A data point I looked at yesterday was some US mobility data that shows that people are traveling less, they're moving around less. If you think about when the pandemic really hit back in April, the mobility numbers dropped 25% from the baseline in January. So people were traveling 25% less than the start of the year. Mobility increased a little bit around June, July, but then it's been steadily decreasing since July. And mobility numbers this week were down 18% compared to the first week of January. Now, of course, as people move around more, they're spending less. And I think we were hoping to have some sort of recovery by June. It's looking more like fall before we start to see any sort of form of normalcy where we start to move around again. And of course, moving around means we're spending more retail spending, more restaurants, more traveling on planes, more spending on services. So I feel like it's going to be more of the same for the first half of this year. Consumer packaged goods are up 8% year over year. But in contrast, alcoholic beverages are up 25% year over year. So frozen food sales are up about 20% year over year. So I think we'll still continue to see this bifurcated market where carriers in the space where people are eating, schooling, and working from home, those carriers will do well, and carriers that aren't in those sectors, in maybe the heavy industrial manufacturing and machinery areas, they'll continue to struggle. And that's where the PPP2 loans come in to maybe support some of those carriers that will struggle.
Yeah, I mean, I think we've never really seen what this looks like, right? So like the reverberations of, I guess the bigger question is, all of those things can hold true and we still don't have a clear picture of what that means for the spot versus contract markets, right? Because we've only studied those things in what's essentially been normal for the last 100 years. Right, we've never seen where you have this. If we were coming into the year at 2019 price levels, I think we'd have a lot more surety about what that meant. We'd say, wow, this is going to be very inflationary on spot rates. Everything we've just mentioned since we wrapped up the standard material for the week would typically speaking be very inflationary for spot rates, right? but we've never entered into a period where we have we've talked about this friction point, and although it's a free market, there is no natural ceiling on where rates can go. There are market pressures and mechanisms and things in place that slow down the increase of spot rates and then eventually stem it back downward. So unless there's going to be shifting market fundamentals that fundamentally raise that ceiling, I don't know that. My take is that cheap money and high rates will continue to flood the market with capacity, and if anything, you're going to see a snappier correction once those trucks hit the road.
Mm-hmm. Yep.
I think that's probably the most, like the median outcome is probably somewhere in the moderate to severe correction. But I think that you cannot completely bank on there being a correction. And I think more than just that, like the timing of the correction is also something that's going to be.
Oh yeah. I mean, yeah. First of all, I mean, to those listening, I'm really curious to see, because we're always trying to get the opinion of folks what you're seeing closest to it. And by no means are we kind of going on the fear-mongering approach that the whole world's going to fall apart. But I do think that you're in that cone, right? To give it a weather analogy, you're in the cone of the hurricane. So although I wouldn't pack up everything and head north right now, because to hold the analogy, the thing's still spinning out in the Gulf, but I would at least go get some bottled water and make sure the generator's gassed up. Mm-hmm. And, be prepared for the more likely outcome sometime in 21.
Completely.
Before we get into some of the Q&A that we have coming in, if history's proven one thing to be true that hasn't changed, it's that people love lists. So do you want to walk us through, if you don't mind, some of the highlights of our top 10 markets?
Yeah, we took a look at our top 10 freight markets last year. Not a lot of surprises here, although some of the West Coast markets around Los Angeles and Ontario skewed things a little bit with the preponderance of import volumes because of the pandemic. But it's still pretty much held true. The split between dry van reefer and flatbed, 72% of our loads were in the dry van space, 18% reefer and about 10% flatbed. That pretty much lines up with the equipment allocation across the industry when we talk to most OEM manufacturers. So no big surprise there. Number one market in both Atlanta, in reefer and dry van is Atlanta. Again, it's a very big distribution market, huge population. It serves a lot of the Southeast. The number one destination out of Atlanta, Lakeland and Miami, and the Charlotte market. They're the top three markets out of Atlanta. In the refrigerated market, again, it's almost the same. Lakeland, Jacksonville, Miami, Charlotte, all in the top lanes out of Atlanta. In the flatbed sector, Houston, obviously it's right at the sort of the western extremity of Gasoline Alley that runs between New Orleans and across the I-10 there. You've got some of the biggest chemical plants in the country there. So a lot of dry bulk, a lot of bulk tankers, a lot of dry bulk cement, a lot of flatbed, a lot of drill pipe, sand, things like that for the fracking industry. So you see a lot of volume moving out to the Permian Basin. The number one lane there out of Houston is New Orleans. Dallas, Fort Worth, and Dallas are obviously pretty big markets on the import side. And then, of course, as we covered last week, one of the major destinations out of the flatbed market in Houston is Lubbock, Texas. That's our 2020 freight market summary.
Hey, Dean, I think the noticeable omission for me is, right, so if I was to give a pop quiz for a new freight person when I was at my previous company, the top 5 dry van markets you'd have Chicago, Houston, Atlanta, LA, and then however you want to consider like Northeast Pennsylvania, Jersey kind of area. But so like Elizabeth, New Jersey is missing from that list. Is that COVID related? Is that just kind of the way that we've classified? I mean, because you could theoretically lump together Joliet and Chicago and then have an extra space or kind of some of those other ones.
Yeah, I think that these, what I should have mentioned earlier, these are spot market loads over 250 miles. So what you see out of Elizabeth, you see, if you think about where they are, whether it's Baltimore, you can cover a big chunk of the country under 250 miles. So I just looked at the long haul spot market loads. Okay. I should have clarified that.
That makes sense. Yeah, so Elizabeth or that Brooklyn to Harrisburg.
Right. You got it.
Okay. Super popular lane with Amazon in that area now, right? Little startup, moving some online freight. All right. So with that, I'm going to thank you, Dean. And you can find this on the website, right?
Correct. Yep. That's posted at DAT.com.
And drop us a line down below. We love making infographics and lists. So if you want to see anything else as it pertains to this, we're happy to, do this. We're doing this for you guys, for your information and for your education. So if you're interested in seeing top markets for specialized equipment or commodities, drop us a line, let us know. We're happy to throw that together and talk about it on our show. So Kevin asks, which this is an excellent question. Do you guys talk about cross-border rates and what are you seeing in, specifically Canada?
Mm-hmm.
And I will say before turning it over to the person who's going to give you actual information, this is one of the number one things that come up because I'm not super well versed in it, but I guess there's still some pretty stringent cross-border limitations as it pertains to immigration, and not that it's immigration, but just kind of there's some border intricacies with COVID in Canada right now. But I'll stop talking and turn it over to Dean.
Yeah, I've noticed in the last few weeks we've seen a lot more volume come out of the buffalo market in particular, which I suspect is import related. I can't sort of categorically say that, but volumes have definitely been up out of buffalo. They're up about 12% month over month. A lot of those loads though are relatively short haul. Detroit, a little bit Elizabeth, New Jersey, so that's a little bit longer haul. But not a lot of those loads are moving too far. Rates were pretty flat this week out of the buffalo market. On the produce side, most of the produce comes in through the main port of entry. I think about 25% of all the volume comes across the main border. This week, according to the USDA, about 65% of that volume was potatoes out of PEI. So a lot of the big in the reefer sector in particular, most of the produce volume is coming out of Mexico. So not a lot of produce comes out of Canada, and we're starting to see some increased volume, which could be port related. But it's a good question. I'll have some more import data tomorrow to dig a little bit further into that. So maybe we can take that question on notice and get back to Kevin next week with what we're seeing.
Awesome. So Javier asks, what do you guys think is driving tight dry van market in Texas, specifically Dallas, Houston area?
It's a great question. I'm just quickly pulling up the data here out of the volume data out of it's up 28% week over week out of Dallas. So there's been a big surge in volume there. What I think the study we did on Houston markets, there's a direct connection between loads going out of Houston into the Dallas-Fort Worth market and then going on to other markets from there as a distribution hub. So my theory was, when we looked at the data last night, that a lot of that import volume that came in December into the port of Houston ended up in the Dallas-Fort Worth market, and then that volume is being pushed out of there. The number one destination out of Dallas was Denver, and then San Antonio, and then Phoenix, Arizona.
Yeah, I think it's that's always been a really hot market, but particularly now, I think that's an interesting area.
At the start of the show, we were talking about, the Houston market, the congressional spending that they've given the Houston market to widen and deepen the harbor and allow bigger vessels in is of the level of impact that we saw when they raised the Bayonne Bridge in Elizabeth, New Jersey. It's going to allow so much more freight volume to come into the Gulf Coast in particular. And that's why I think you're going to see a lot more volume come out of those distribution markets around Fort Worth and Dallas.
Yeah, I think, how would you compare it to Savannah too? Because when they dredged that out, I don't know what the inlet or whatever they call that is, but I mean, that was a huge boon down there to allow the new larger vessels and more of them coming in, right?
Yeah, those volumes, when I looked at the November data, their year-over-year TEU volumes are up in the order of 30% year-over-year. So they've like a lot of East Coast ports that have spent money on bringing in bigger ships after the Panama Canal got rebuilt and widened. They've all benefited from higher volumes, but I will sort of say that those volumes are slowing down last week in particular. So I think that's related to the overall slowdown in import volumes out of Asia, because I think a lot of inventories have been restocked and replenished. So we may see, even though volumes are up year over year, it should start to decrease if the current trend holds.
For sure. That ties into one of the other questions. I think it's a good follow-up about cross-border between Mexico and U.S., and I think you can paint a very similar picture by looking at some of those stateside markets that are more near the border, right? And you see higher relative demand there, and you can make a pretty good assumption about what's happening cross-border.
Yeah, I mean, that's where I think there's a lot of opportunity on our, if carriers and brokers looking at our 3-day rates, for example. We talked about average spot rates this week, all markets in the $2.50 range. But if you go to markets like Nogales, Texas, it's about, if you look at all cross-border volumes, about 24% of produce loads came across the Nogales, Arizona border up through, Tucson. The number one lane there is Chicago. 3-day rates are up 20 cents a mile last week to about $2.78 a mile on average, but as high as $3.18. So I think there's certain lanes and certain markets that follow seasons, and that's where our adage of don't ask, no. A lot of our 3-day rates can actually show where the opportunities are for a lot of those that are in the market.
We have a couple more here, and since we started late, I'm going to try to touch on some of them. Jack had some great comments in the comments about kind of some of their thinking on market correction. I would say that I won't speak for DAT. I tend to be a little more bearish than that and a little more chronologically forward and when I think some of that correction will happen. But we will get, so we've made kind of a decision, and if you guys don't like that decision, feel free to let us know, to show the year-over-year longer-term forecasts about once a month, because they just don't change enough to show every other week, and it kind of is hard. We're spending more time level setting on what's going on than we are talking about the forecast. So our plan is to show that essentially the last show of every month. We're going to show the year-over-year long-term forecasts for the 3 equipment types. So that will be not the next show, but the show after that. We should have that loaded up. But so this is a lot of really great questions today. You guys are lifting us up for where we're falling a little flat here. So Stefan from Blue Grace asked, even with an increase in Class A truck orders, wouldn't we expect some tightness in capacity given the shortage of available drivers? So That's one for you, Dean. But I feel like we were up at our hunting camp this weekend with someone who drives for a regional LTL, and I feel like we need like a entire show or two on sort of contextualizing the driver shortage and what's narrative, what's actual. But to answer the specific question, Dean, what do you think?
Yeah, I think we're definitely going to see shortage of drivers and tight capacity, but it's going to be in different sectors. So I wrote about this last week on the market update. We've had a net 2% increase in capacity over the course of the year. Mega fleets have had trouble finding drivers, licensing, testing them, getting them through training schools that haven't been open. That's a legitimate concern. But smaller carriers haven't had any problem adding capacity because of the high spot rate. So I think we'll see tight capacity in some sectors, plenty of capacity in others, based on the ease it is for drivers to get into and out of the industry. So yes, there could be some capacity tightness on some of those large volume lanes where there's a lot of contract freight moving. We did hear last week from some shippers that carriers are still not accepting any loads over what's contractually committed. Rejection rates in the 40 to 50% range. So capacity is still genuinely tight on some lanes in some markets. So that could persist all the way through the middle of the year when some of these new orders from last September and October start to come out onto the market.
Yeah, I think it's obviously going to be deflationary on rates,
Right.
kind of in the macro sense. I do think that it'll be interesting to see, especially as we kind of get on the other side. I know it's crazy to think about when we get on the other side of the 4th of July. Because really, if you order a truck today, when's the feasibly the earliest it would be on, powered and on the, under a trailer and on the road with a driver?
Typically in the 6 to 9 month range, depending on the factory build speed. But the factories have been talking about difficulty in finding employees and putting in extra, COVID-related safety requirements spacing people out. So that's the big concern, is finding people to actually build the vehicles.
Yeah, so that does put us squarely. I've heard some regional reports, depending on where you're in the country, there actually may be inventory, almost like walk-up inventory for some of these, especially the non-specialized kind of your standard power unit type thing. But once these things hit the road, it's not just orders today, right? We've seen elevated orders. Was it as far back as October? September, October.
Correct.
They've been on a run since about then. So you could see, I just don't foresee a world where too many of them are sitting there without drivers as we head throughout the year, especially if we see the stickiness in the contract rates that the bids that cleared in the fourth quarter of last year. I think that'll be enough to shake loose the necessary drivers to get behind the wheel. So with that, we are at time. I'm going to wrap up for the week. First of all, thank you guys for bearing with us through the technical difficulties. Point you guys to Dean's Market Update on our website, as well as the Freight Find podcast, as well as we archive all of these shows historically. So if you're interested in a topic that we had in the past, you can go find those on our YouTube or somewhere out there in the ether. We'll link you to in the description. But like and subscribe so you can see all of our new content that we'll be releasing in 21. And we will see you 10 a.m. Eastern next week. Thanks, everyone.